Hello and welcome. This is Matt Leatherman from FCLTGlobal. Thank you for joining us for the seventh in our series of webinars about managing investment risk for the long term. Today's topic is navigating crises as long-term investors. FCLTGlobal's purpose in convening this webinar and all of our webinars has been to apply research in ways that can move money in long-term directions through risk management. Today, we're so fortunate to have with us someone who's made that his career. We have today as our guest, Mark Kritzman, who is the founding partner and CEO of Wyndham Capital, as well as a senior partner at State Street Associates and a senior lecturer at MIT Sloan School of Management. Mark has created many of the risk estimates that we've discussed previously in this webinar series and we'll be discussing today as well. FCLTGlobal's frame of reference for this content is a 2018 publication called Balancing Act, Managing Investment Risk for Multiple Time Horizons, and also some content within our publication on institutional investment mandates. Bryn Costello is the producer for this series. She can answer any questions that you may have about the technology, as well as take questions from you. For our meeting today, you can reach Bryn at bryn.costello, bryn.costello at fcltglobal.org. Our session today is recorded so that we can archive it on our website in the spirit of continuing professional education. It's a 60-minute session, and we will end promptly at 9:30 Eastern Time. With that, Mark, thank you for being here with us. Perhaps we'll begin with a straightforward level-setting question. We've talked in this series throughout our 7 months together about the value at risk and probability of loss statistics. Can you provide some perspective about what those statistics tell a long-term investor and what their limits are?
Sure. And Matt, let me just thank you for having me and thank everybody in the audience for joining in. It's an honor. So I guess the way to think about it is you can imagine a whole bunch of possible paths that an investment can take a portfolio. And, some of the paths are less likely than others. And if you were to just look at the distribution of the endpoints of all of those possible paths, it would look like a bell-shaped curve. So what probability of loss, the way it's conventionally measured and value at risk as well, tell us only about the ends of those paths, right? Mm-hmm. So we have this normal distribution of ending outcomes, and what we can say is, what fraction of those outcomes were, represented a value less than we started out with, and that fraction would be the probability of loss. And then, value at risk is just flipping that around. It's just at a given probability, what's the worst that can happen. But the key, I think the key issue here is that approach, the conventional approach to thinking about risk, ignores, what happens along the way, right? Some of those paths that ended up with very good outcomes may have along the way generated significant, within horizon losses. So, that's an important question. I think institutional investors, well, I don't think, because I've been in the business so long, I've heard this over and over and over again. They say we're long-term investors, right? And I think people are long-term investors, but they can't ignore what happens along the way because that could derail their long-term plans. And I think the prototypical example of this, and I've used this example so many times, I feel a little guilty toward Harvard, but look at what happened to Harvard during the financial crisis, right? They were completely illiquid, and they're long-term investors, obviously, but this completely derailed this massive development plan they had for their Alston campus. Now they've sort of resurrected that construction bet, but it's just a shadow of what it's was formerly envisioned to be. And they also lost a lot of faculty, right? Because they You couldn't pay them for a period of time. So there are, real economic consequences to short-term sell-offs. So I think the challenge for most institutional investors is how do you balance your goal to grow wealth over the long run with your aversion to experiencing significant sell-offs along the way.
I appreciate that. The framing of risk relative to your purpose is something that comes up often in our work and is always a healthy reminder. You've helped to pioneer a statistic that allows investors to do this, the application of value at risk to within horizon value at risk. Can you talk about how that within horizon computation can complement the more usual VAR statistic? And also, are there any limits to the within horizon value at risk computation?
Yeah. So many, many years ago, I was consulting to the Rockefeller Foundation, and they said they wanted to come up with an asset mix that had a very low probability of losing more than a certain amount over a 20-year horizon. And, I thought about it for a minute, and it occurred to me that, any asset mix whose return was just slightly higher than their spending rate would satisfy that criterion. So I just put the question back to them and I said, so does that mean that you're going to meet with your investment committee just once, and it's going to be at the end of the last day of the 20th year? What happens if you're down 10 or 15 or 20% next week or 2 years from now or 5 years from now? Would that matter? And they say, yeah, well, of course it would matter. So that's sort of what inspired me to look into figuring out how to calculate these risk measures within horizon. So we came up with a solution that's based on a statistic called a first passage probability, which I don't need to get into, but the way to think about it, so unlike the conventional approach to probability of loss and value at risk, which just pays attention to the distribution of ending outcomes, these within horizon probability of loss and value at risk pays attention to the portfolio's value at every point along the way. So it says, in terms of probability of loss, what's the if you're concerned about losing 10%, what this statistic answers is the likelihood that your portfolio will be down 10% from its beginning value at any point throughout your investment horizon. And the within horizon value at risk is what's the worst that can happen. How far down can your portfolio go if you monitor it continuously throughout your investment horizon? And just to put this into perspective, if you have, say, a typical risk profiles, like a 60-40 stock bond mix, the likelihood of let's say a 10% loss at the end of a 5-year horizon might only be about 5%. The likelihood of being down 10% at some point during that 5-year horizon is about 50%. So it's 10 times as great, which is not to say that you need to invest differently, but it is to say that you need to manage your expectations so that when something like that does happen, you don't therefore change course, unless there's good reason to, but you don't change course just because it happened, because there's also, there's obviously a huge chance that you're going to recover by the end of the horizon. So it's just, I think in terms of managing expectations of an investment committee, it's important that they understand the distribution of outcomes that happen within the horizon, as well as those that they should expect for the end of the horizon.
That point about surprise and panic has permeated our research and is one that we return to commonly. I'll ask a question in two parts. One is, to what extent have you seen institutional investors put that statistic or maybe any others like it to work? And to either extent, have you seen good practices for anticipating surprise so that folks beyond the risk practice, trustees, for instance, are able to preserve their focus and see their way through crisis disruptions when they have a reasonable expectation of recovery?
Yeah, that's a very big question. Um, so, we've worked a lot at trying to gauge the exposure to loss from surprises. We've done a lot of work in that area. One of the things we did, and this goes back to the late 90s, is we created a statistic called financial turbulence. And it basically uses a statistical measure of unusualness as a proxy for turbulent markets. And what we discovered is that if we partition history into those periods that by this measure would be deemed turbulent versus those that are not turbulent, that most losses for all kinds of risky assets occur during the turbulent periods and not during the calm periods. So one of the things that investors can do when they want to stress test their portfolio or try to have a better appreciation of its exposure to loss is to estimate the probabilities, whether it's within horizon risk or end of horizon risk, based not on measures like correlation and standard deviation that come from the entire history of returns, but rather on measures of risk that are estimated from the turbulent subsample of returns. I think that would give an investor a much more realistic notion of their portfolio's exposure to loss. The other measure that we developed, and this was just after the financial crisis when all of a sudden everybody started talking about systemic risk. And I think prior to the financial crisis, most investors didn't know the difference between systematic risk and systemic risk. It turns out that they're effectively the inverse of one another. But in any event, so there was a lot of work being done in government to measure this systemic risk and to identify systemically important financial institutions following the financial crisis. And it was very laborious and data intensive and subjective. And what we wanted to figure out is, can we come up with some statistical measure of systemic risk that could be calculated very quickly using information no other than security prices, just that. And we did. We used this tool called principal components analysis. And what this does is it identifies the factors that are driving the variability of returns. And and these factors are statistical factors. They just basically are, how different assets co-move to drive the variability of returns. And you can associate them with fundamental factors like energy prices or interest rates or things like that. But that's not important for this purpose. So what we wanted to do is identify the factors that are determining, volatility, and then basically compute the fraction of the variability of returns that is being driven by just the first few factors. Right. And we call this the absorption ratio, right? So the idea is that if just a small number of factors is driving a large fraction of the variability of returns, that means that the markets are very compact, very tightly coupled. Right. And when the markets are in that state, they're very fragile because shocks travel, quickly and broadly when everything is tightly coupled. So, and then if you think of the converse, if it takes a lot of factors to explain the variability of returns, What that tells us is that risk is diffused across many independent sources. And when, that's the state of the markets, they're much more resilient to shocks. So, so this measure, which we term the absorption ratio, how much of risk is being absorbed by these few factors, is a very good indication of a market's fragility. And one of the experiments we did is we looked at all of the major sell-offs in our sample, 1 day sell-offs, 1 month sell-offs, 1 year sell-offs, and we calculated what fraction of those downturns were preceded by a spike in the absorption ratio. And what we found is that almost all of them were. But you have to be careful in how you interpret that. So just because most sell-offs are preceded by a spike in the absorption ratio, it doesn't mean that most spikes are followed by a sell-off. Because what this is capturing is vulnerability to a sell-off, right? To actually have a sell-off, you need two things. You need for the market to be vulnerable, and by that I mean tightly coupled, and then you need some bad news.
Right. I'll jump in here. The questions are lighting up both via text and online. This is, I think, why people are in the room. Let me assert the moderator prerogative just to ask one follow-up, and then we'll start weaving in several audience questions. The issue of how to interpret the statistics, I think, is fore of mind for so many people, and they're required to think about it in a package. We've surfaced the concept of within horizon value at risk, a more ordinary or mild metric that just tells you about pathways, and then also the concepts of turbulence and absorption. Can you say a word about how a long-term investor might package these insights up, and if there's any practice recommendations that you would make for interpreting that combination of information?
Yeah, I guess based on what I've described so far, the measures of value at risk and probability of loss can be used to understand a portfolio's long-term vulnerability to bad news, right? How much, how risky is my portfolio? Assuming that I put it in place and then maybe just rebalance it periodically, but don't do anything proactively to change its risk profile, right? So those measures are going to tell you how much exposure you have to loss. This measure of financial turbulence, which we have since extended in, I think, some interesting ways, which I hope I have time to talk about, and the absorption ratio. So we have these two measures. So the financial turbulence is telling us how unstable markets are. And the absorption ratio is telling us how tightly coupled markets are. And those two in combination are a really good indication of market fragility. So that's information that you can use proactively to tilt your portfolio to or away from risky assets. So the idea is when the markets are in a very fragile state, you might want to tilt your portfolio more toward defensive assets. And when the markets are in what we would call a much more resilient condition, then you would tilt your portfolio more toward growth assets. So the idea is that you can use these within horizon probability of loss measures just to understand the risk exposure of your portfolio strategically. And then you can use these measures of financial turbulence and risk concentration to actually, to modify your portfolio dynamically throughout your investment horizon.
This gets squarely at a question that's come up, and forgive me, it might be a bit repetitive, but the audience is quite interested. So let's make sure that we go into it at good detail. The question is, regarding these turbulent versus calm periods, whether you can identify them prospectively or retrospectively. I infer that there might be some opportunity to identify them prospectively.
Yes, the answer is yes, you can. Obviously not perfectly,
Right.
but on average, you can do so in a way that would be helpful to your portfolio. Now, of course, you have to take into account, the size of your portfolio and how nimble you can be. But one nice feature about turbulence is it is persistent. It's not unlike the turbulence we used to encounter back in the old days when we used to fly, right? That it would start suddenly, oftentimes unanticipated, sometimes anticipated. The pilot might come on and say, we're about to go through, a turbulent patch. But once it begins, we know we're going to be in it for a while because it takes time for the plane to get through it or to find a calmer altitude. And the same thing is true of the financial markets. Turbulence arises unexpectedly, and it's caused by all kinds of different things. But it has a common feature despite its source, which is that it tends to last for a period of weeks, and that risky assets respond the same way. They tend to do badly during turbulent periods, and that makes perfect intuitive sense because when markets become turbulent, investors become fearful. They retreat to safe assets, and by doing so, they sell risky assets and drive down their prices. So it's a natural, almost inevitable consequence of turbulence. So you could, even if you can't forecast the onset of turbulence, if you react to it quickly once it gets underway, on balance, not always, but on balance, you can avoid some losses. As far as the risk concentration, which we measure with the absorption ratio, is concerned, that's something that actually tends to persist for even a longer period of time. But again, it's more an indication of vulnerability to losses rather than there are losses that are about to come, right? It's just telling you that the risk is it's so concentrated that if there is bad news, the outcome, the reaction by the markets is going to be greater than normal. So you can measure both financial turbulence and risk concentration on a daily basis and monitor it. And you can come up with some kind of trading rule to adjust your portfolio depending on what levels you observe.
I infer that there's not only the opportunity to avoid some losses, but also that just being able to communicate this information about the periods that you are entering can help trustees or executive management, again, preserve their focus and not panic as they go through those periods. Is that a fair inference?
Yeah, it's a very good inference, Matt. So I'm guessing there are a lot of investors who, either, for whatever reason, don't feel confident engaging in, dynamic asset allocation. And it's sort of funny, we used to call many years ago, it was called market timing. And that sort of had a bad connotation after a while. So then it was changed to tactical asset allocation. It was the same thing. It's changed the name to tactical asset allocation. And that also had a bad connotation after a while. So now we just refer to it as risk management. So far, that's okay. But in any event, if you don't want to engage in, let's say, dynamic risk management, I think, again, just managing expectations, right? Good thing to do. And and you can say we're in a fragile environment. We should expect that if there's some bad news, our portfolios, could suffer. Hopefully, most likely this will be a transitory outcome, and we'll recover and carry on. We shouldn't panic and think that we've got the wrong asset mix, for example.
For sure. I have a question about a fourth potential statistic from someone in the audience. The question is about the Sortino ratio, or a downside focused volatility measure, and whether that plays a role in this package that we're discussing. What are your views on that?
Yeah, the Sortino ratio. So the standard deviation measures variability around the mean and doesn't distinguish between upside variability, which basically tells you your opportunity for gains, versus downside variability. The Sortino ratio, is obviously a natural thing to do. It measures deviations either below the mean or below some threshold that you define. So it just tells you about volatility, downside volatility. So that has, a lot to recommend it. But it assumes, obviously, that returns are not normally distributed, right? It assumes that there's some kind of skewness that we need to account for. And that's certainly the case with lots of assets. But there is this notion called the central limit theorem, which provides a very strong pull toward a normal distribution. So the Sortino ratio is out there. I don't think it's been put into practice very much. Let me say this: we've come a long way from looking at standard deviation and downside risk. So, for example, I mentioned earlier this measure of turbulence, right? The way we measure turbulence does not distinguish between unusual outcomes on the upside from unusual outcomes on the downside. It just says markets are unstable. That instability could be that, we're having significantly above average returns, right? So the same statistic that we use to measure turbulence, which is called the Mahalanobis distance, can be, so the Mahalanobis distance, it's a way of measuring statistically how distant something is. So when we measure turbulence, we're saying how distant are current conditions, taking into account, by conditions, how distant are the co-occurrence of a set of, say, asset class returns from their average values, taking into account not just how each asset class return differs from its average, but how their co-movement differs from the average co-movement. So it takes into account interactions. That's what's so nice about this, which standard deviation or the Sortino ratio doesn't. So, but keeping in mind that the Mahalanobis distance measures distance. So for turbulence, how distant are you from average or from normal circumstances? Right? We can use that exact same statistic and say, how distant are circumstances today from past periods when the market experienced a really big sell-off, right? So we can actually use it to measure, instead of distance, how similar are circumstances today to the circumstances that occurred when the market did very badly, right? That's a much more sophisticated way of getting at downside risk than the Sortino ratio. Way more sophisticated because it takes into account the co-movement of all of these returns.
That's really helpful. Thank you. We have more questions coming in from the audience than we can get to right now, but I promise that we'll keep them in the queue and make progress. Mark, I want to give you an opportunity that you alluded to a few minutes ago. You said that it would be nice to be able to talk about the extension or the application of some of your work on turbulence, and I want to give you that opportunity.
Yeah, well, yes, thank you. And that's one of the things I just did by saying how we can extend turbulence to similarity to bad market. But the other thing we've done, we've made two what I think are very important extensions. One is we've applied it to scenario analysis. So you can think of there are essentially two ways to build portfolios. One is called mean variance optimization, which is statistically driven. And the other is called scenario analysis, where people, they put forth various scenarios and they define those scenarios typically as perhaps outcomes for, relevant economic variables. And then they assign probabilities to those scenarios, and they come up with some weighted average outcome of the future, and then build a portfolio that they deem would be, they judge to be suitable for that, weighted outcome of those scenarios. So the biggest challenge, if you think of all of the steps of scenario analysis, the biggest challenge by far is how do you assign probabilities to scenarios, right? And I believe I know the way it happens is people, they sit down in a conference room and they discuss these scenarios and they debate them, and then they assign numbers to them, and they probably have somebody there making sure the numbers add up to 100%, right? And it's typically the person who's most senior in the organization whose views get, views are given the most consideration. But my point being, it's a subjective, unscientific process. Well, the alternative is simply to use again the statistic Mahalanobis distance, and say, here are these different scenarios. One could be recession, stagflation, robust growth, whatever. And for those scenarios, you have values for GDP growth, inflation, the unemployment rate, maybe the slope of the yield curve, right? That's how you're defining these scenarios. Maybe they start out as narratives, but at some point those narratives need to be translated into numbers.
Right.
So you have a set of numbers for each scenario. And what you can do is say, well, what are the values of those economic variables today? And how distant are each of these scenarios from today's values, right? What is the distance? And by distance, what you're really saying is how unusual would it be to have this scenario unfold versus that scenario? And you can mathematically convert this distance into a probability. So now we have a scientific way of assigning probabilities to scenarios. And you don't have to accept those probabilities, but they should at least be your point of departure. This is what this is a mathematically driven, empirically driven estimate of the likelihoods of all of these different scenarios. So that's, I think that's an important extension of literally, financial turbulence. It's taking the same math and using it to estimate the likelihood of scenarios. And then the other, the natural extension, we recently did some research evaluating the plausibility of the Federal Reserve's stress test scenarios that they impose on banks, and using the exact same methodology. How plausible, what's the distance of these stress scenarios from current circumstances, or could be just from the historical norm? Are they plausible, or are they so implausible that they're just causing banks to lock up a lot of capital unproductively for no good reason? So, that's another application.
A question that we get when it comes to these historical comparisons oftentimes is about the representativeness of the data being compared. When you look further and further back into history, whether you're getting comparisons that are still material today. And that could be perhaps in the context that you've just mentioned, certainly in the context of the time unit of observation when you're sampling variance. Some would say that if you go to longer time periods than the status quo of monthly, that you start pushing yourself back into less representative periods. Do you have a view about this element of historical data and how relevant that can be when you're thinking about managing risk today?
Yeah, I have a very strong and well thought out view. So I should say thought out mainly by my co-authors, but it's still well thought out. Yeah. So Dave Turkington, who you may know, and Megan Cesanis and I have written a paper on relevance, and we're also working on a book that addresses this topic. And the basic theme, I guess there's several themes about how to think about this. One is that the way we typically learn from experiences is not necessarily consistent with what science directs us to do.
Okay.
So typically what we would do is, first of all, we would, we record experience as narratives. This is our, our intuitive way of processing data or observations. And then what we say is, so what periods in history are similar to what's going on today? And what happened back then? And maybe that's what's going to happen today, right? So what that tells us is that, so this is the whole notion of relevance. So that's telling us that, one component of relevance is how similar observations are to current circumstances. The other idea is our intuition tells us to put more weight on unusual past occurrences because they sort of reside more prominently in our memory. And so the other component of relevance is unusualness, but we call it informativeness because from information theory, what we know is that information is inversely related to probability. The more unusual, the more informative. So we have this notion of similarity and informativeness. So what we want when we look at our returns, our sample of data, what science tells us is get as much data as you can because you're going to get a more reliable estimate from having a lot of data than just a small amount of data. So they don't say anything about you should only look at similar observations, right? And to the extent you get rid of any of this data, you should just get rid of the outliers because it may reflect errors in your data or it may reflect events that are not going to reappear. And what our intuition tells us to do is focus on data that's similar to today and that's unusual. So it's almost the opposite of what science tells us. So our goal is to try to reconcile this. And what science might tell us is, okay, maybe you shouldn't have the biggest sample you can get because sometimes we're told to use rolling windows or things like that, right? So it's telling us that more recent data might be more relevant than more distant data. Well, it turns out that recentness has nothing to do with relevance. It could be that some of the recent data is more relevant just because it's similar and it's unusual. But we've tested this in a variety of ways, forecasting presidential elections, the stock bond correlation, all kinds of things. And so it's not just our conjecture. There's actually a mathematical equivalence that underpins this notion of relevance. So I guess that's a very long-winded and perhaps indirect way of responding to the question. But what we want to do is focus on data that is similar to current circumstances, but different from average circumstances. That data is much more relevant. And if we use that subset of data to make our predictions, more often than not, we'll end up with more reliable forecasts.
I'll jump in here because we're alluding to one of what seems like harder problems of the practice, and that is our own behavior. You've identified some statistical methods that we can control our behavior and put our focus where scientifically it belongs in order to preserve focus on the long term. There's also the matter of actually putting this to use. In order to do what you just described, you have to run the computations and conduct the practice. Our impression, which could be wrong, but our impression is that implementation of these ideas still leaves a good bit of opportunity on the table, that it's not gone as far as it can. Can you say a word about the extent to which you see long-term investors behaving as you've described? And do you have any views on what it would take to advance implementation further?
Yes. I think that investors seem to have very entrenched ideas that come from their training, probably in business school, that haven't really advanced very much in practice. And I think part of it, I can speak, as having one foot in academia and one foot in industry. I think a lot of academic research is pretty incremental, right? If you think about how you succeed as an academic, you start writing papers based on your advisor's research, and you make small advances. But it's that kind of a incentive system makes it hard to make leaps, right? I think in practice, we're faced with necessity, right? We have to invest through a pandemic, right? We have to invest through the global financial crisis. Bonds are yielding close to 0%. Where are we going to find return? That tends to, I think, trigger more imaginative ways of dealing with these problems. So I think there are solutions out there. There are better ways of doing almost everything that we're doing. And I think, there's just this tension between what's entrenched in our training versus the new techniques that are available to us. So, if you don't mind, I can drone on for a while about this new approach that we've come up with, Dave Turkington and I, just recently. I mean, we just, I just sent him the final draft of the paper last night. And it's a way to build portfolios that simultaneously account for history, for shocks that may have occurred historically, but we think might be more frequent going forward, and even shocks that have not occurred yet, as well as drifts, right? So we all know what history is. We get our sample of returns. We have good return data going back to the 70s for a lot of asset classes, and that period is pretty rich. You've had the energy crisis, you've had stagflation, you've had the stock market crash, the dot-com bubble, the global financial crisis, the pandemic, this assault on American democracy, and on. It's just wars. It's just replete with all kinds of major events. So it's a pretty, one could argue it's probably pretty representative of what might happen going forward. So that's a good point of departure, right? We can observe history going back that far, at a monthly interval, and that's pretty good for building, say, institutional portfolios. But we might want to think about shocks, like, I think it's very likely that we're going to have pandemics way more frequently than we have. I saw an interesting piece that, it recorded pandemics going back to the year 0. I don't know where they got the data, but apparently from 0 to the year 1800, they occurred every 100 years. And from 1800 till about 1980, they occurred every 25 years. And then since then, they've been occurring every 4 years. And, it stands to reason because, humans are more interconnected and we're more connected to nature. So, it's a stretch to think that pandemics are going to be a more frequent occurrence. Hopefully the technology will outpace that. So we can think of shocks as like another pandemic, another financial crisis, some kind of, disaster that affects our infrastructure, like the Fukushima meltdown, all kinds of, some kind of geopolitical crisis. in any event. So we have these shocks, and we can also observe them, at a pretty high frequency, like monthly or even daily if we want to. So we want to account for shocks along with what occurred historically. New shocks or more frequent shocks. Then the other thing we want to account for are slowly emerging forces that gradually cause asset prices to drift apart or move synchronously.
Right.
So if you observe, the returns of the major asset classes at a monthly frequency, you might observe that they're positively correlated. But there could be this underlying force that's causing these asset classes at a much longer frequency, like a multi-year frequency, to be drifting in the opposite direction, right? So a drift, a kind of a drift scenario. So far we have the historical scenario, shock scenarios, and then we have drift scenarios. So what the prototypical drift scenario is climate change, right? We know it's happening. Does it show up in returns? It may, the relationships may not show up in monthly returns, right? And moreover, the forces of climate change so far in history may be latent. They may not yet have surfaced in the financial markets. So what we'd like to be able to do is to account for these drifts. Another one would be technological displacement, robotics and things like that. And so these we can only observe over very long intervals. And so what Dave and I have come up with is a way of creating a return sample that mixes the historical record with some views about future shocks, along with some views about drifts, observed at different frequencies. And the trick, the key innovation in this research is how to properly balance the, these returns in the return sample. And there's actually a precise, mathematically correct way of doing that. So what we end up with is, we have this intuitive view that the future is going to be some mix of what happened historically, new shocks, and these slowly emerging forces like climate change. We build a return sample that captures all of that. And then what we do, rather than mean variance analysis, which would say, let's just, summarize that return sample with, means, standard deviations, and correlations and find a portfolio, we can actually use, now that computers work so fast, we can just by trial and error plug in, tens of thousands or hundreds of thousands of portfolios until we find the portfolio that gives us the highest utility. And when we do that, so that's a portfolio that is basically designed to give us the best possible outcome we would like, given this view that the future is going to be this mix of history, shocks, and drifts. So
I want to make
doing that. There's not a single person on the planet who's doing that right now. And I think this is the way to go, because, and it also gets back to your earlier question, Matt. Somebody in the audience posed a question about, how much can we rely on history? Well, in this case, you don't really have to. You can speculate. I think, we have to worry about these shocks or these drifts, and these drifts haven't shown up in historical pricing. But what we can do is we can just from first principles say, well, if we get climate change, I think it's going to have this effect on stocks and this effect on bonds. And we can add a drift term to all of the historical returns to reflect these emerging forces. So it allows us it basically formalizes how we intuitively would think about the future, and then allows us to build a portfolio that is, based on a scientific process.
It's really interesting. I'm sure I and all the audience look forward to that forthcoming publication. I'll make a quick administrative note to the audience and then return to our last few questions. For our audience, we're entering the last 10 minutes of our time with Mark. Again, we will end promptly. So if you have any further questions, please do get them in now. Mark, I'll raise one more and then we'll see if the audience has information coming in, and then I'll reserve the last one to be open-ended, anything that you might want to say that we haven't covered yet. The one that's on my mind is how we communicate this entire suite of conversation that we've had today. At one point, you used the metaphor of flight, and that metaphor comes to my mind often as well. You can think about the inputs that you put in before takeoff, perhaps in terms of your time unit of observation for investing. You, of course, think about your destination. Those are your usual VAR, probability of loss statistics for the endpoint. You would have an idea about what your altitude is going to be, your goal, and that's your within horizon boundaries. And then you have a plan for turbulence and disruption as well. Is that the right metaphor for relating this to a broader audience of decision makers? Do you have a different one?
Well, obviously it depends to some extent on how familiar the audience is with some of the more technical aspects of all of these tools and approaches. But I think what the direction I'm trying to move into is some way of reconciling, the scientific tools that we have with how we intuitively think about the risks we face in our goals, and trying to move away from this, statistical abstraction. With what Markowitz did was just genius at the time, 1952, and that's really withstood the test of time. But we don't have to do it that way anymore, because we don't have to rely on statistical summaries. We have the computational power to deal with much more nuanced features of the data, and also, probably more important, more realistic descriptions of our preferences. So Markowitz, mean variance, you can only describe your preferences in terms of mean and variance. And most investors care about thresholds, right?
Yeah.
If you breach a particular threshold, circumstances for you change qualitatively, and mean variance can't deal with that. So but these, we now have the tools to do that, and so I think we just have to find. We know how we think about things intuitively. We have way more computational power and way more data than we used to have. We just have to figure out. Now that we're not forced to use these statistical shortcuts, we have to figure out how to match our scientific methods with what we know intuitively.
Sure. I want to make sure that you have ample time to open up any other things that may be on your mind. So I'll go ahead and just give you that open-ended question. Is there something that we should have discussed today about how a long-term investor thinks about multi-horizon risk that we haven't and you would like to mention?
I think we've covered quite a bit. I guess the other thing, this sort of gets, I guess there is something we should talk about. And it sort of relates to the question you raised earlier about the Sortino ratio. So, the way we build portfolios, using the mean variance approach or some variation of that, is to calculate these summary statistics, right? So the world is really just a statistical abstraction of all of this detailed information that we have. And one of the statistics that's really important is the correlation. How do stocks and bonds move together, for example? Are they giving us the diversification we think we're getting? Well, the way we do it is really not at all helpful. It's just not helpful, because we don't care about how assets co-move on average across all return outcomes, right? Typically, equities are the main growth engine of an institutional portfolio. And we want to find asset classes that, diversify equities when they're doing badly, not when they're doing well. And the correlation coefficient, if it's estimated from the full sample of observations, doesn't make that distinction, right? So what we want to do is compute conditional correlations. What are the how are bonds, for example, correlated with stocks when stocks are doing badly? Right? That's when we want that's when we want diversification. When stocks are doing well, we want unification. Right. So we need to come up with these more nuanced, correlation profiles of different asset classes, and that's a tricky thing to do computationally, but we can do that. It's sort of, I'll pose a question to you and to your audience. I've recently learned that many institutional portfolios have some Bitcoin in them. And I just wonder what motivates an institutional investor to own Bitcoin. It's, I think, people may believe that it's a gold substitute and that it might provide some protection in the event of some kind of crisis or left tail event. It turns out that if you look at the correlation of Bitcoin in a very sophisticated way, it doesn't provide any diversification benefits whatsoever. It has the exact opposite profile that one would like. It unifies with stocks when they do badly and diversifies them when they do well. And you want exactly the opposite. Yes, most major college endowment funds now have investment in Bitcoin. It's had an annualized return of about 90% and, standard deviation of, 1 or 200%. There's no fundamental value to it. So I'm just wondering, what motivates people to own it? We try to figure out what kind of preferences could justify owning Bitcoin. It would be a lottery-like preference, I guess.
I wish I had an answer for that question, Mark, but I do not. I have so enjoyed this conversation and appreciate it greatly. We are nearing the end of our time. So let me take a moment to say thank you for being with us today. This was tremendously enlightening and we really appreciate it.
Well, it's my pleasure. Thank you. Thank your audience. It was a lot of fun for me as well.
Absolutely. I'll go ahead and conclude with just a few programming notes and a look ahead for the audience. Let me also say thanks to our team that makes these webinars possible. Bryn Costello, who of course is on your screen as our producer, and also Alan He, who is our resident quant, a rising star at FCLTGlobal, and has helped me prepare and develop questions for Mark as well. Again, we do this webinar series purposefully. We're trying to help focus capital on the long term through the way that we manage investment risk. Accordingly, we're here to support you if you have any follow-up questions or see ways to apply our research. We encourage you to reach out. You can reach me personally at matthew.leatherman@fcltglobal.org or the research portion of the institution at research@fcltglobal.org. Also, all of the research on our end that you've heard mentioned today is available on our website, fcltglobal.org/resources. Our next and our final webinar in this series is going to be on April 14th. It will be at a different time than the ones that we've had previously. It will be at noon Eastern, and it will feature a conversation with Professor Andrew Lowe, Mark, who I know you know well, and it will be on the subject of how we find opportunity in all of these risks, particularly that low probability but very high consequence upside opportunity that we would call a moonshot. And so we look forward to welcoming Dr. Lowe on April 14th at noon. Registration is open at the same place where you registered for today's event. And we hope that you'll join us for this culmination of our risk webinar series. Thank you again, Mark. Thank you to our team. And thank you to the audience for being with us today. Have a lovely day.
Thank you.